Hi my future millionaires, welcome to the Finance Talk. In this guide, I will walk you through the steps you'll need to take in order to invest in the Indian stock market, including how to open an account, how to research and select stocks, how to manage your portfolio, and finally I'll mention a very important point at the end. So stay tuned and watch till the end. So let's not waste time and dive in. The first step in investing in the stock market is to open a brokerage account. A brokerage account is a type of account that allows you to buy and sell shares in the stock market. There are a number of different brokerage firms in India, so it is important to choose one that is reputable and offers low fees. When opening a brokerage account, you will need to provide personal information including your name, address, PAN number. You will also need to provide proof of identity and proof of address. Some popular brokerage firms in India include ICICI Direct, HDFC Securities, Kotak Securities, Zerodha, Upstocks, Grow. I personally use Zerodha because I find it easier to use and the fees are reasonable. I link Zerodha into the description below. It is very easy and straightforward and is done online through an app. So everybody get set up in Zerodha and start investing today. Once you've opened a brokerage account, you will need to research and select stocks to invest in. There are several different methods you can use to research and select stocks, including fundamental analysis, technical analysis, and quantitative analysis. Fundamental analysis involves analyzing a company's financials, such as its income statement, balance sheet, and cash flow statements, in order to determine its intrinsic value. Technical analysis involves analyzing a company's stock price and volume in order to predict future price movements. I really don't want to bore you with all this financial jargon. Fundamental analysis of companies will be a topic for another video. I know this is the most difficult part and can be confusing for most of us, but don't worry, this is something we will learn on the go. If you're a beginner, which I'm sure most of you are, try to begin with investing in the Nifty 50 index fund, which automatically invests your money in the first 50 companies by market cap. The second best way is to invest in blue chip stocks. Blue chip stocks are companies that are generally stable and have a strong track record and are well established. These stocks are also considered to be less risky than other stocks, making them an ideal choice for those who are new to the stock market. Some examples of blue chip stocks are Tata Consultancy Services, HDFC Bank, and Reliance Industries. All these are not stock recommendations. You have to do your own research before investing. If you like the video so far and you like the setup today, a subscription will be awesome, and smash the like button. Once you have researched a number of stocks, it is time to start building a portfolio. A portfolio is a collection of stocks that you own. When building your portfolio, it is important to remember to diversify, meaning having multiple stocks from different sectors, which will reduce risk, and not to over diversify, meaning investing in more than 30 to 40 companies, which will reduce your rewards because any profit that will be made will be averaged out between these stocks and overall returns will be diluted. It is also important to remember that no stock is a sure thing and that past performance is not indicative of future results. So only invest if you truly believe it will grow. Once you have built your portfolio, it is time to start managing it. This includes monitoring investments, making sure they are performing as expected, and making adjustments when necessary. One important aspect of managing a portfolio is keeping an eye on overall risk level. This means monitoring your portfolio's performance and making sure that it is not heavily concentrated in one stock or sector. Although if you have done your research and have invested in concrete, foolproof stocks that will withstand the test of time, you can simply sit back and keep investing periodically without any change. The final and the most important step, actually not a step, but something you have to follow like an advice, is to have patience. This may sound pretty simple, but trust me, it is a very difficult job. Investing in the stock market is a long-term game and it is important to have patience and give it time to grow. Stock markets can be volatile in the short term, but over the long term, they tend to increase in value. It is important to have long-term perspective and not to get caught up in the short-term fluctuations. This is where most of us fail. When we invest in companies on tips and recommendations from friends and we don't inherently believe in those companies, short-term fluctuations sends us into a panic sell. Holding on to stocks even when it falls 50 to 60% is hard and will only be possible if you solidly believe in the stocks you're investing in. An example is Rakesh Jhunjhunwala, who bought Titan shares in 2002-2003 when it was merely 3 rupees. Cut to 2005, his shares were 40 rupees. Fast forward to 2009, his shares were still 40 rupees. Almost 4 years went by with zero returns, and tell me how many of you can watch your portfolio not give you any returns for 4 to 5 years. He believed in the company and he knew it will grow. And this analysis came true. History always has rewarded the risk takers. Now he has a stake of 5.1% in Titan, which comes to around 11,000 crores in today's money. I hope I have given you some sense of what the stock market is. As always, please do subscribe and smash the like button if this was helpful. In the next video, I'll do some live investing and I'll show you my whole portfolio so that you'll get a better idea of what I said today. So I'll catch you in the next one. Peace.